In this week's update, so many reasons for the market to fall, but it's the Fed. Don't fight the Fed. And how to think about market opportunities. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, let's just step back and have a look at what happened here, because last Sunday we just had a 7% drop in the US markets on Thursday. It was a very, very decisive move to the downside. 9 times out of 10, that downside will continue. But on Monday, that all pretty much changed because the Fed stepped in and announced a corporate buying program that, look, frankly, wasn't new news, but the market is in a mood where it wants to respond positively to any sort of news. And there was some good economic data as well, or better economic data, better than expected. And hey presto, that one-day event just basically evaporated. And we didn't get the follow through that last weekend just looked incredibly likely. So there are absolutely no end of reasons. You could sit down for an hour and make a list that ran for pages about why the market should fall, but it just absolutely refuses to. And so at the end of the day, just yet another lesson to follow the tape and not follow logic. And, there's just so many things that are going to change in the next 6 months, quite apart from the virus. And we're now seeing Victoria starting to wind up again, restrictions around the virus. So, I mean, who knows what next week or next month is going to hold. And then, of course, over the top of this, we've got the most significant event really of the year, and one of the most significant events I think for society, and that's the US election, because there is such an incredible divergence between the policies of the two parties and the ramifications for the market that it's really quite unpredictable. So to me, that's the wild card for the second half of the year. And therefore, it's really important to have an open mind and be able to accommodate the views of others. Take on board both sides of any argument and weigh it up in your own mind and see what conclusion you come to. But I still see comments from people that, I don't know whether they're grandstanding or not, but they just want to take this one-sided view and tell you how it's going to be. And it's really unfortunate that those people are so blinkered that they can't actually accommodate any other side to the way that they see it. And generally, I'm not seeing a lot of people actually with a truly open mind and prepared to accommodate whatever might come. Bias is pretty much everywhere. We're seeing it in society all over the place. And people are really looking for what they wish to see. And if you do that in financial markets, it's not a good thing, I can tell you. You need to have a clear game plan. You need to have discipline. It's never been more important than where we're at right now. And I think the next 6 months is going to be so many cross currents in financial markets that it's just going to be an extraordinary period. The weak sectors trade. So we had, coming out of the middle of March, we had a rebound in technology and healthcare, and all the usual suspects went up first, and then the laggards and the ones that deserve to be lagging, the airlines and the travel stocks and banks and all those stocks that were significantly affected by the lockdown. We got a bounce in them, and that was always going to be a short-term bounce because it was largely built around a short squeeze. That's what it was, and that tends to be a bit of a fleeting phenomenon. And so that trade, I think, is over. There might still be a few stocks that continue to rebound, but I think the risk reward around that weak sector rebound now is unattractive, and we're seeing normality resuming with technology and healthcare stocks rebounding as well. So the data came out during the early part of the week as well. That is also helping the fact that the Fed stepped in and said they would start buying corporate bonds, not only in the primary market, but also in the secondary market as well. So the data specifically in the US, there were blockbuster retail sales. We're seeing the manufacturing outlooks are strengthening quite quickly. Now, okay, they're coming back from negative, So, it's easy for the numbers to be getting better, but the point is they're getting better at a rate that is faster than what people expected. We've seen the jobless claims falling for 11 weeks in a row, again coming off an absolute disaster when the lockdown first started. But 11 weeks in a row, the jobless claims are falling. That's a fact. Home builder sentiment is surging, and the surge has been the largest in history. And we've got the Fed is going to be hoovering up corporate bonds basically as required. A limitless supply of money to prevent bankruptcies. Now, this wasn't new news. This was really first postulated in February, I think it was, and has been in partial operation. But the Fed made an announcement about it, I guess particularly because of the big fall we saw on last Thursday night, and that just turned things around instantly. And finally, it always gets down bigger picture to earnings. Earnings have got to be growing because the market is factoring in improved earnings in the future. And so we are seeing the earnings outlook stabilising. The valuations at the moment, trying to value a stock based on where their earnings are going to be in the next 6 to 12 months is a bit of a fool's game. So that's a bit of a nonsense at the moment. But the sweet spot is still with companies that are capital light, means they don't need much money to expand, they don't need to take on debt, and they can grow their revenues with a very high degree of probability. So that's where you need to look, because they're the stocks that are going to continue to prosper in this environment. So let's look at the scoreboard. The S&P going 2% for the week, and basically the Fed rode into town and just overwhelmed everything else. There was every reason for the market to fall and follow through after the previous Thursday, but the Fed just completely swamped that out, and hence the term "don't fight the Fed" was proven to be true yet again. Bullish sentiment was down, bearish sentiment was up, which is what you'd expect. And this is not where you get major market tops. You get major market tops when there is an environment of enthusiasm, and even over enthusiasm. So yeah, we might get a bit of a pullback, bit of a sentiment-driven situation, but that's not where you get very significant turning events come from. The US dollar edged back higher to 97.5, and the 10-year yield was steady at 0.7. So if we look at the S&P, this area here around this peak, around 31.25, which was the peak from early March, when we just had a 3 or 4 day rally before it all fell apart again. So we managed to break through that with almost not a pause. And then we got the sudden breakaway move the Thursday, the 11th of June, which with a big gap, a huge candle accompanied by really big volumes, you would expect that to follow through. And hence my call that people should really look at raising some cash, reducing exposure, because that's a pretty high probability event. And that was the correct call at the time. Now, the Fed rode in, the market's turned around. We've come back up to that level that's providing both support and resistance, and we're just fluctuating up and down. So at the index level, this is 50-50. Anyone that reckons they know which way the market's going from here is kidding. This could go up or it could go down at the index level. I'm not terribly fussed, to be honest, either way, because what I'm focused on, and these aren't recommendations, but what I'm focused on is stocks that do this. This is Zoom Communications, one of the huge beneficiaries of the global lockdown. Just look at what's happened to that business and to that stock price. And in Australia, let's look at Appen, a stock that's, yes, it's expensive, but the outlook for Appen is terrific long term, and the market is rewarding the stock accordingly. Look at the breakout. Look at the volume patterns around the breakout. So don't worry about what the index is doing. Just focus on individual stocks. There's the US dollar. So this level, the important level of support at 96, has continued to hold, and the market is, or the US dollar index has started to move up again. As a consequence, the Australian dollar continues to pull back from the resistance level at around 70.5, and we actually finished the week at 68.3. So 68.3 was where our dollar finished. Now our index was higher by 1.6% on the week, and I suspect that we'll probably, at the moment, the futures in Australia are pointing to a lower opening on Monday. But again, as in America, you know, I really don't pay much attention to the index. It gets a lot of media coverage, but you know, frankly, I don't see the point if you're an individual stock trader. Technology is back in leadership. Appen is obviously one of those, but there are many others. So it's really the stocks. So this is the blueprint you want to look for. It's stocks that have got a globally scalable business model. They're capital light, means they don't have to take on much debt, and they can grow their revenues exponentially without the need for much injection of capital. They're the stocks that are in favour. So, you know, just go and find them. And that's all that we've had in the Insiders Club or Portfolio Analyst portfolios for quite a long period of time. All right, turning now to precious metals. Gold was up $11, finished at $17.43, and is getting very close to a key level around $17.50. And then, of course, we've got a major resistance level just above that at 1800. So with the dollar where it is, that corresponds to an Australian dollar gold price of 25.50. The Australian gold producers producing in a range between, let's say, 1100 and about 1300 Australian. So that means that they've got a massive profit margin there, and so no wonder the Australian gold stocks are doing well. The future speculators are not yet in the market. If you look at the number of contracts that are held to both the long and the short side in the futures market, they're just not participating. They're still heavily cashed up. And the future speculators, because they use such high leverage, have a disproportionate impact on the market, on the gold market. Now, as I pointed out last week and the week before, the futures market doesn't sustain a trend long term, but it can certainly propel it for shorter periods of time. So if we get a breakout above 1800, I think the futures speculators are going to be forced to come into the market, and that could really put a fire under the precious metals market. In the background, though, what is really encouraging is that investment demand, and I covered this in detail last week, but investment demand is still surging. That's not letting up. So that's a really good sign for the longer term. And if we turn to precious metal stocks, GDX, another week of holding support. Most of the stocks are really just consolidating the gains from earlier in the year. So if we turn to the gold price. So on a daily, you can see we've really just been in this sideways band since around about the middle of April. Just up and down, really pivoting around this level, probably around 1725. But the moving averages are still heading up. The 20-day is still above the 50, so we've still got good alignment there. They're way above the 200-day, so it's still a very positive uptrend. And if we switch to a daily, you can see just how graphically the gold price, the strength of the gold price move since the lows which occurred at the end of 2018. So we're talking 18 months. Gold has been on a really strong rally from 1200 to 1750. Now we've got important resistance here coming up at just under 1800, and then of course the all-time highs at just over 1900. A move above 1800, I think, will absolutely force the hand of the futures guys, and that'll really give the price a kick along. Just looking at silver also consolidating. as well. The silver to gold ratio is still out of whack. Silver still needs to strengthen relative to the gold price. So I still see a pretty positive outlook for silver. And if we just have a quick look at GDX on a weekly chart, we're still holding this key support level, and it was a positive week for the sector. Turning to other commodities, copper was up again a little bit more, and it's really just reflecting the global growth expectations. So the global growth is not there yet, but certainly the expectations are improving. Whether that turns out to be a false hope or not, again, remains to be seen, but at the moment, that's what the market is factoring in. Now, crude oil also rose to just under $40. It's stuck in the high $30 range, so it's really in this range between $36 and $40. US production is still falling, but we've still got a market that's basically out of balance. There's the spot copper chart. And just to wrap it up, the one-day event, which was the Thursday before last, 7% down, closed on the lows, massive volumes, just an absolutely horrible, horrible session, just went away. It just disappeared. Now, if and when that comes back again, and I wouldn't be surprised to see more events like that come along in the next 6 months, I think it's best to step back and reevaluate, reduce your exposure, cash up, and if it proves to be unnecessary, then you can get back in again. But it's better to do that than to hope that the market doesn't fall further, and then of course, one day it will. So to me, I think you've just got to be responsive in this market, or you need to be completely long-term thinking and just say, I'll ride through whatever. And that's fine, and that's a strategy. The only problem is that most people can't do it because as we go down in a market crash scenario, most people can't take the pain, and they generally decide to get out near the bottom. So it's all well and good in theory to say, well, I'll just ride through it, but practically most people can't do it. So I think it's it's going to be a better strategy for most people to just be more responsive in the market. Now I think where we are now, certainly the impact of the previous week is probably now dead and buried. And so some cash can be deployed back into the market now, but you really need to be restricting yourself just to high probability setups. And I also point out, because I do get a lot of questions, don't try and pick the bottoms in beaten down stocks because the risk reward is just not attractive. Yes, you might pick up some significant percentage gains by stocks that have been absolutely murdered, but the probability of making a successful trade out of that isn't all that strong. Focus on the sectors that have got the enduring growth. Now, Portfolio Analyst last week, we added another 10 bagger to the portfolio, and there'll be plenty of interesting things to talk about this week. So if you want to find out more, there's information on my website, and also there's my email address for anyone that wants to communicate with me. That's it for this week. Cheers.